So hello everyone. Today I'm going to talk about how insurance companies manage risk. So what is risk? Everyone and everything has risk. Risk is really the possibility of something bad happening, something which would yield undesirable consequences. So for example, when you gamble, you're taking a financial risk, and there's a chance that you will lose your money. And fortunately, risks like gambling can be avoided. But in our everyday lives, we're constantly exposed to risks. When we drive a car, for example, when we take an elevator, when we cross the street, all these things have risk. So it is very important that we protect ourselves from the possible consequences of risk. And the common way people do this is through insurance. Insurance is when an individual transfers their risk to the insurance company for a premium. And the premium, for those who don't know what it is an amount of money that is paid periodically to the insurer, so like a fee. So as the business of insurance companies is holding the risks of other people, they need to be able to determine which risks are worth holding and at what price they should set the premiums. And one of the ways insurance companies do this is through risk pooling. Risk pooling is a very common form of risk management, and especially in insurance. And the idea of risk pooling is that the risk for one person is not the same as the risk for society at large, if each person is independent. So, for example, a health insurance company, they would group individuals whose medical costs are similar in order to calculate an average premium. So let's say that we have four groups, one group of 100, 1,000, 100,000, and a million people. Assuming that these people have the same general risk characteristics, so for example, if they're all men, 65 years old, non-smokers, they have a normal weight, and with no evidence or history of cancer and no heart diseases, if they're tracked through a period of time, what will happen is that the percentage of men that die in the sample of a million men will be more accurate than the percentage of men that die in the 100-man sample relative to their risk. And the reason why this happens is due to the law of large numbers. So the law of large numbers, as you can see here on the screen, it seems very complicated, but it's actually pretty simple. And it states that as the number of participants, n, increase, the average outcome is likely to get very close to the expected value. So in other words, the more people there are in the pooling arrangements, the more accurate the predictions are. So back to our example, the more men there are in the groups, the more accurate the prediction of the claim is going to be. So why is this important for health insurance companies? Well, if you think about it, insurance companies depend on how well they're able to predict these future claims. Because if they're not very good at it, they would lose more money through claims than they would win through premiums. And so the business wouldn't be sustainable. So statistical tools and the law of large numbers are essential for these companies so they can guarantee long-term results and so they can profit. Unfortunately, in practice, this does not work very easily. And here is where the first layer of complexity comes in the world of insurance. So the law of large numbers and other statistical tools, they're actually not very effective because they don't take into account moral hazards and selection bias. And these factors distort the way insurance companies operate. So moral hazard is when people, knowing they are insured, they take more risks. So for example, if your car is insured against accidents, you may be more careless when driving because you know it's insured. So what happens is that the risk goes up. Or for example, even worse, if you want a new car, or if you think the insurance company values your car for more than you think you can sell it, you could just crash it on purpose and then pretend it was an accident. And this way, you would receive more money from the insurance company than you would selling the car. So it is very difficult to create insurance policies because there needs to be a sense of integrity between the policyholder and the insurance company. Now, selection bias is different. Selection bias is that the insurance company may not be able to see all of the risk parameters that defines the risk of their customer. It is basically the lack of communication from one party to the other. So for example, health insurance. Health insurance tends to attract sick people. So what the company will do is that they will ask for medical exams. And they will do this so they can eliminate the people who they already know are going to be sick and therefore costly for the business. So if they do not require exams, what would happen is that mostly the sick people would be the ones signing up for the insurance, as they know they will need it. And this would raise the price of the insurance premiums. And therefore, none of the healthy people would be signing up because they wouldn't want to pay for the expense of the unhealthy people. And so the whole system would collapse. So what insurance companies do to overcome these problems is that, first, for moral hazards, they design specific contracts that will cover a part of the cost if any accidents happen. And for selection bias, as mentioned in the previous slide, the companies can conduct exams and other tests to see how healthy the person is, and therefore decide if they're going to insure them. And here is where the second layer of complexity comes in, because of ethical issues. So ethical issues arise. So basically, insurance practices can be seen as wrong, as insurance is fundamentally a form of social responsibility. So therefore, giving insurance should not be only about profits, but also to help and protect society as a whole. So for example, it would be extremely unethical for an insurance company not to provide insurance for a person which is dying of cancer, only because they wouldn't be able to pay for the costs. So it could be argued that requiring these medical exams for insurance policies isn't very ethical, as that would give the company the option and power to exclude that person from their pool of risks, and therefore that could make the person die because they wouldn't have any support. And a great example of these issues are subsistence farmers in Asia. So there are many farmers in the rural areas of Asia that depend on the crops that they grow every year to survive. But every now and then a storm happens and kills their crops. So to deal with this issue, they will need to buy crop insurance so that whenever the crop fails, they can receive money from the insurance company and buy food for themselves. And even though this sounds like a workable idea, it is subject to manipulation. So the farmer could easily lie about their crops, saying that they didn't manage to get a yield, and the insurance company would have to pay them. And the same thing could happen on the parts of the insurance company. They could simply choose not to insure the farmer when their crops fail because they are too risky. So what happens is that, so the conclusion is that insurance is actually a purchase based on trust. Even though there are many tools which help to separate and quantify risks, it really depends on the integrity of both parties so the system can actually work. So what happens nowadays is that insurance company, they require many regulation and processes so that both parties don't feel they're being in an unjust agreement, and therefore the system can work. So I hope I could give you a bit of an overview of how this works, and if anyone has any questions, I would be glad to respond.
Right, thank you, Lorenzo. And I can safely say that Lorenzo has ensured we're going to be thinking about this for the long time now. Thank you, Lorenzo. If there are any questions from the floor, just please raise your hand and I'll submit the question, or I can open your microphone. Right? And anyone? Oh, we have a question here. I'll see. Luca Carroll, you can open your microphone and ask your question, please.
Okay. So Lo, nice presentation. I thought it was very enjoyable, and I'm just curious on you. I'm sure you're aware of the free rider problem, especially with healthcare insurance companies. And do you know like what kind of techniques or tools these companies use to kind of eliminate the problem?
Yes. Okay. That is a very good question. So as I was saying, insurance is a very complex business because of the free rider problem, because of these ways that people can take advantage of the system. So what they do, one of the ways they eliminate this problem is through they randomize the people who they're going to give the policy, the people who they're going to insure. So they not take into account the problems of other people. And it is actually much more complex than that, because nowadays these companies, they're actually dealing with insurance on an individual level. So what that means is that they will create a package, an insurance price, a premium, really um, customized to that person. So it wouldn't happen of the free rider problem wouldn't happen, because instead of having a average insurance premium, they would calculate a deal which is ideal for you, and not for a person which has the same general characteristics than you. So this is one of the ways they could avoid this problem.
Thank you, Lorenzo, for that. Thank you, Luca, for the question as well. So that concludes Lorenzo's presentation. Thank you very much. Now we have